All right. Well, good afternoon, everyone, and welcome to the final last week in mortgage today of 2021. And as always, pleased to be joined by one of our lender members from the All-Star list to come in the co-host chair this week. Back in that spot, the president of Go Mortgage, Chad Jampedro. Chad, how's it going, bud?
It's great. Thanks for having me. Appreciate it.
Absolutely. And before we get into it, a lot of news to cover. I want to get into a little bit of next year and your outlook on the year ahead of us. But how did the year end up for you guys?
Listen, it was a great year. We're coming off the two best origination years in the history of mortgages, right? So, it's hard to find a time when, production, really stayed as consistent as it has at those levels. So certainly pleased, but I'll tell you that our team certainly can use a little rest right now. This week is a good little catch your breath week and an opportunity to plan for the future a bit. And we anticipate, as most will anticipate, a year that is going to be different than the past 2 years. You're really a focus on purchase. We're not going to see as much refinance overall, just volume being down. But when you think about it, we were seeing that we're seeing growth years prior to 2020 into 2021. Hopefully we can get back to that, and certainly we'll look fondly over the last 2 years for sure.
Yeah, a year ago, coming into the year that's about to come to a close, so many more unknowns, really. I mean, we were still in the throes of a mad crush of volume. And there was really a lot of unknowns. Most of the projections for the industry in terms of total originations were in the high twos of trillions. We're going to end up at almost four. So a far busier year than anyone anticipated. That had some crazy cycles to it. But as we head into next year, it's all but certain that we're going into, a down climate, just simply because of the amount of additional people that refinance this year and some of the
Sure.
prevailing headwinds to the purchase market, right?
Right. The refinance fatigue is real. You have extended periods of time with low rates, historically low rates, and it seemed like they continued to get lower and lower. And think about it, we had a captive audience in a lot of ways. So, mortgage originators should look to the media outlets and thank them a great deal, because in talking about that every time, it's historically low mortgage rates. That's driving folks to websites, into your offices to talk about that opportunity, existing homeowners. At the same time, I think it drives purchase volume to say, if I was thinking about purchasing and rates are as low as they've been, and they're historically low, now is a great time. So, that captive audience piece, I think, was also an element of that. Coming into 2021, folks are still working from home, a bit more time, let's say, on social, a little bit more time in front of the TV. And I think that certainly, has helped us, from a volume perspective.
Absolutely. And still a lot of unknowns as we head into next year to be certain, but just talking to yourself and the other great leaders in our network, they're really preparing their companies for a different type of cycle and battening up the hatches and looking for ways to operate more efficiently, and just from a technology and platform standpoint, looking to put their company on the path to what lies ahead, and probably a little bit of downtime, relatively speaking, in the last year and a half. It's been so crazy to do that this winter. So
Sure.
We'll see what happens. So let's get into the news, and let's start, since we were kind of towing around there, with projections. 2020, a record year for the industry, over 4 trillion in total originations, depending on which number you look at. MBA's number 4.1. MBA now projecting this year, the year we're about to finish up, will come in at 3.93 trillion in total origination. So just off about 4% from that crazy year we had last year. And then looking forward into 2022, projecting 2.6 trillion, more of the historical normal cycle levels, where they anticipate total originations will sit, if you look into 23 and 24. Does that marry up with how you guys are looking at things at Go Mortgage?
It does. We're anticipating certainly a slowdown on the refinance side. We kind of covered that a little bit with the refinance fatigue. And then as you look at housing and appreciation, these are at all-time highs as well. That means demand is there on the purchase side. And the expectation is certainly growth on the purchase transaction side as we go into 2022, but certainly not enough to cover that difference in refinance. I mean, we're talking about intoxicating levels of refinance over the last 2 years. I mean, you're drunk with refinances, right? And what will be interesting is as we level out and it's a bit more balanced, what we really want to drive into is margins. How do margins hold up, right? So we can control margins in a sense. We can't necessarily control inventory. We can't control overall volume, but we can control our margins. And one of the things that has occurred over the last 2 years is that you are forced to find efficiencies inside of your business, and really, create opportunities there for savings, for efficiencies from a speed perspective. So let's see how that plays out in 2022. We're going to be very practiced mortgage bankers. And for those that were navigating through really challenging times over the last 18 to 24 months, you learn new skill sets, right? You had to adapt to a climate that we just all didn't anticipate. Now, as we go into 2022, let's see that on display. What does that do for margins? And then how do we drive value to the consumer sooner, right? And how do we educate more? I think those are all things that we get back to, right? I think we all have had a list of, hey, when this ends, we're going to get back to talking about these things. So 2022 is going to be that year.
Yeah, those of us that have been in the industry for a long time, we've been through these cycles before. And, I truly believe what I've seen is with our industry, but more broadly in life, like when you are at your extremes, the crush of volume that we saw a couple Septembers ago, where lenders were really struggling to deal with that. And then now the cycle that we're going into now, where, you've got MBA projecting volume is going to drop off by like a third. Great companies prosper and grow market share. I mean, their total originations may not grow, but typically good companies are able to grow market share during times of extremes, one way or the other. Companies that poorly handled all the volume that came in, or companies that have not properly positioned themselves for a different type of climate. And I'm sure, just knowing you, that's something you've been talking to your people about
for sure.
Better part of the last this year.
We were talking about it as it was happening, to say, okay, and scaling it, adding bodies in a lot of ways. It's kind of the easy answer. Is there, can you utilize technology, leverage it a bit better, moderately retrain the staff that you do have to pick up efficiencies? And we really wanted to focus on that while the pressure was on. Then that helps us at a time where, we didn't have a big, massive swing in expenses. So, you can slip into a year like 2022. You're not necessarily going into it where you think, well, I've got to, cut staff or really, cut into the human capital piece of the business, which is a good thing. And in that, you can continue to support. And, again, we're in a competitive marketplace. Our industry is highly competitive. We're going to have companies that are going to struggle with that. And sales folks are going to, really gravitate towards those strong lenders that make those really good choices, find those efficiencies, and then can still support them in that market at a high level. It's just that natural survival of the fittest and then, really you could see it in our industry a great deal, but in all industries, right? So I think those that managed it well and looked around during this period of time, I use the word intoxicating, if try to stave off that intoxication a little bit and learn some lessons along the way, I think they could, be applied in 2022. And it's an opportunity to grow and grab a bit more market share.
Very well put. This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative this week, joined by Go Mortgage President Chad Jampedro. Chad, all kinds of news releases this past holiday week in and around inventory and home values and home sale price values. We'll start with the Case-Shiller Index because it came out just a few hours ago. This being the industry relied upon monthly home value tracker that tracks home values in a bunch of major cities across America. up 19.1% year over year, October to October. This is in line with these monthly year over year numbers we've seen that have basically shown home values have gone up around 17 to 20% year over year on average. You look deeper inside the numbers, Tampa, Miami, and Phoenix, which we've been calling on this show and others the poster child of potential home value trouble. 32% home values up year over year in Phoenix. If you look again closer inside the numbers, the month over month increase was just up, depending on which metric you look at, 0.8 or 0.9%. So it shows a slowing pace of appreciation, which at this point, honestly, we're hoping for, that would seem to be indicative. It feels like now we're rolling at this like 10% year over year appreciation pace, but dwindling. You look at the projections for next year on home price appreciation, you still have some people out there really bullish saying 12, 13, 15, 18% in some cases, a lot of others more dovish in the 5, 6% area. Just your general thoughts on home values and appreciation and how you seeing that play out over the course of the next year here.
Well, I'll tell you, you're right. I think we'd like to see that the heat come off of that just a bit, right? It kind of, as it gets to those somewhat unhealthy levels, if you could say that, it's the best word I have to describe for it. It forces some borrowers into scenarios which we've heard about, right? Which is no appraisal, no contingency, things like that. Which in my mind, I feel like those are dangerous considerations, and it's really driven by a hot market. But that kind of slowing down, I think, is a bit natural. Again, you can't be at the top forever, right? There are going to be some peaks and valleys. Balancing out makes sense, but demand still continues, which I think all of us can look to that. The pros that have been in the business for a number of years, seeing that demand, those early stage KPIs of pre-qualifications, those are still rolling in. When you take a look at the home build numbers, right? So we're seeing those at November numbers were tremendous numbers, right, for new homes. So the demand is still there, but seeing it slow down a little bit, not a surprise. Rates tick up a little bit, that has an impact. You take into consideration weather, that has an impact, right? Fatigue as far as inventory. How many home seekers can't find that perfect home? After a while, it gets to be, well, maybe I'll wait a year or two, and come back into a market that's a little less hot. So it makes sense to see those numbers start to slow down a bit. However, I think we can all have confidence in the fact that the demand still exists, and we're seeing that in our businesses day over day, and numbers are showing that. But look, 10%, I think we'd all take that. I mean, it's still a tremendous number. When you compare it to the last couple of years, maybe not so much, but historically, still fantastic.
Yeah, and as you noted, no sign of any slowing on the demand side. On top of that, you've got the federal government doing things that are boosting the demand side. If it's some of the things they've talked about, and certainly will be doing on the affordable housing and low to moderate income side is going to help the demand side. Some of the other things that have been bandied about that will do nothing but increase demand. On the flip side, though, the supply side, you look at the inventory numbers. Again, this year we talked about the weird cycles. Jan, Feb, it was like busier than people thought. You had this little
sure.
And then the madness in the spring, where there was just this home buying frenzy. Inventories dipped to the lowest levels we've ever seen. All the reports of 50 offers on homes first day and 100,000 over asking and waiving this, waiving that. And then inventories slowly throughout the spring and summer. I think it was September where we saw inventories at their highest level of 2021. But now, as we get into the tail end of the year, we're back at the April levels. Inventories now nearing those record low levels. And, so that's something. And we had the concerning part about that to me is I distinctly remember and talking about it on this show a couple months ago, and to some degree they're self-fulfilling numbers that, like Redfin's and Realtor.coms and the Zillows saying in September and October, our surveys indicate we're going to see ridiculous amounts of people list their homes this holiday. But we haven't seen that really. And maybe it'll happen after the new year. But It's kind of weird, the inventory cycle this year. I personally anticipated a lot more people to list their homes this winter, but we really haven't seen it.
Well, we can speculate there of some of the reasons why. I think, certainly when we look back post, mortgage meltdown, right? Building new homes. I mean, we had periods of time where we built, basically nothing for a number of years. So we weren't getting those units coming into the market. Then you take historically low rates. So think about the natural rhythm of, let's say, a downsized buyer, right? So they own a home and, they're going to sell that home and maybe, downsize into something smaller. Because of, what we've seen over the last couple of years, you may be downsizing in size, but you may be buying smaller at the top of the market. So you're not downsizing payment. So now what that makes sense to maybe stay in that home longer. Now the natural rhythm of that home coming back onto the market has been interrupted. So, the way out of that, it's a longer way out than I think we certainly would want to have, with all the demand that we have in place. We've got to build our way out of that. We've got to renovate our way out of that as well. So it's going to take a while for that, that supply to come in line with demand. And unfortunately, we'll probably see some of that demand fall off. That starts to balance out the market. Now, timing on that, that doesn't happen in 1 year or 2 years. It's going to take a period of time for us to get there, to get to a healthy balance. And there's no short, easy way to add inventory, especially now, maybe with rates rising a bit. I speculate this a little bit. It's not as attractive to, let's say, landlords, right? I'm going to buy, let's say, at a higher rate, even though rents are going up. So maybe you're seeing that element leave the marketplace if rates go just a bit higher. And if you take a look at, back in 2018, we touched 5% in mortgage rates the third quarter. I mean, and it didn't really dampen demand at that period of time, but it did a bit on, for those buying for investment. That changes that dynamic a little bit, maybe a little bit of that. But again, we're going to be fighting through this inventory concern for a number of years to come if the demand stays at the level that it is. And it seems like it is staying at that level, even with all the fear, inflationary fear, all of those, we still continue to see high demand.
Yeah, many great points there. The non-owner occupied property factor, it's hard to find stats on that, but you felt it in the industry when Fannie and Freddie tried to put those 6% caps on lenders, which were historically in line with the number of non-owner occupied mortgages lenders sell, Fannie and Freddie. But I think they failed to anticipate that that part of lending was booming and that most lenders were originating at much higher levels. You also mentioned the new construction and the renovation piece. And one of many cool things about Go Mortgage is an independent mortgage banker. That space you guys play in, not a lot of IMBs do. So would welcome your perspective there. There still are obviously supply side issues. I read a column this morning about just lumber prices in general. They're down a little bit now from obviously the insane highs of the spring, but just the column was kind of intimating that they should likely still be volatile as we head into the new year. How do you look at that side of it? It feels like, just talking to other leaders like yourself, anticipating a lot of renovation lending as we go into this year. Maybe that homeowner that's got that cherry 30-year fixed rate in the mid to low twos that all of a sudden, we're just going to add a room onto our house.
Right. For sure.
What do you agree with my?
I do. Renovation is a piece of it. You're taking, let's say, less than marketable properties and making them marketable. So that's, renovation of units that are not currently owned, but for sale. Folks staying in their homes, right? The pandemic brought on the, work from home, really big push, right? And we were still seeing that. So it's, I want to make this home now fit my new lifestyle. There's a demand there. On the construction side, we still continue to see, tremendous demand, obviously, that results in supply chain concerns. And in speaking with builders that we work with, they're moderating that, right? So, you have a global supply chain that's been interrupted. It shifts to a more regional supply chain. That's good, by the way, for the overall economy. I think we would all agree with that. But there still are concerns there. And, they're navigating them. And every day, week, month that goes by, that gets a little better. There's other solutions that are now put into play. I mean, that's the great thing about, the construction market, is that they're going to adapt, just as we've adapted to, the market that we find ourselves in on the mortgage financing side. they're adapting to get these homes on because they want to take, this is the boom for builders that they've been waiting for a number of years. I mean, if you think about, after the meltdown in building, I mean, it grind to a halt. To be a home builder during that period of time was challenging, and then over the years since then, it's kind of come back, but this is that boom, certainly on that demand side. Now, the transition from I want to buy an existing, to the timeline that it may take and the hoops that you have to jump through on the construction side, that's not for every buyer, right? Not every buyer is going to make that leap and go out. And our goal really is to bring, what we consider to be mainstream financing on the construction. We really focus on the single close construction so that, for that buyer, low to moderate build price, they can defer, so they're not making two housing payments at the same time, that rent and, then the interim cost. So that mainstream lending, I think, helps there. But again, not for every buyer to make the jump from I want to buy existing into building new.
Absolutely. This is the last week in mortgage today. I'm Rich Swerbinsky with the Mortgage Collaborative, joined this week by Go Mortgage President Chad Jampedro. Chad, before we get into some outlook and projections for the year ahead of us, just layoffs in general, some news before the holidays, of course, that, the mean guy from better.com made a lot of headlines with the Zoom layoffs, and Freedom Mortgage, some others laying off some people before the holidays. And typically companies don't lay people off in December. So when you see that, it would lead some to believe that, as we get into January, you may see a little bit more of that. We're seeing the numbers in TMC benchmark, volumes dropping off, efficiencies dropping off big time. And, see a lender like Go Mortgage in that sweet spot where you guys are nice sized IMB and have some scale and are able to benefit from the efficiencies of that scale, yet are not one of these massive companies that just has to lop heads and can be a little bit more smart and a little bit more nimble. How do you look at that? I mean, I think if I was in your shoes, I'd be looking at that strategically as an advantage. Like, hey, some of our bigger competitors are about to make some pretty unpopular moves. And what that also does is it reminds people, like, bigger is not always better. Think of all the employees that left mortgage lenders to go to better.com in their, IPO fueled haze of growth and hiring this year. There's always another side to that picture, right?
Sure. Listen, in the end, results do matter. And, the finances of your company, you've got to plan for that. No one company does this alone. We've got many partners that, think warehouse banks, right? They want to understand your plan and your profitability, and there's risk there on their side if that's not happening. So we get that. It's unfortunate, the timing of it. And certainly, my heart goes out to brothers and sisters in the mortgage industry that lost their job during this period of time. But that's kind of that boom scenario, right? Where it's, okay, we want to take advantage of, what's going on in the marketplace. And I would say, certainly we share this with many other IMBs out there and other, mortgage brokers, banks, credit unions. We're a relationship focused company. We relationships with our employees and relationships with our clients, relationships with our referral partners. That is what's most important to us. Now, we had to navigate through that, and you want to take advantage and pick as much low-hanging fruit as you can during boom periods of time. But what we didn't want to do is, lean into the intoxication of it, right? So again, using that word again, that's the only thing I could think of. Now, those companies have to right size, and you feel for those that are affected by it as they, reorganize their plan. What I would say is, again, even if it's consumer direct, I get there's different channels of business. You got consumer direct, and it seems like, okay, consumer direct is, I don't think of it this way, but I've heard it be, order taking type scenario. There is an opportunity there to make relationships. Listen, we're all digital, whether we like it or not. Even if we're really representing one particular area or very hyper local, we're digital in that space. But you can build relationships there. So if the focus of your company is on a relationship with you, and you are working and developing relationship with your clients and with your referral partners, you can navigate your way through this. If it is in that, kind of assembly line scenario, there's risk there, because where are you on that assembly line, right? If you're not owning a relationship and you don't have a relationship with a company that, you can shift and adjust strategies and you feel comfortable doing that, and you have tools available to you to do that, then you may be on really dangerous ground. So, those are the questions I'd be asking myself, as a part of a company these days, to say, do I have a relationship with this company that, makes sense to me and I feel comfortable with? Do I have strategies and tools that I can shift in the marketplace as that marketplace shifts? And am I focused on making relationships with everybody that I come in contact with? If that happens, you navigate through it. If not, you could be on dangerous ground. And look, we're going to see more cuts coming ahead for sure.
Very well said. And as we move into 2022, just, in my discussions with leaders like yourself on a daily basis, some of the things I continue to hear in terms of themes, feel like we'll see in 2022. One is just M&A and just a shuffling of talent in general. Everybody is working remotely now. So many more lenders. If you're a community bank or Go Mortgage, you can operate in all 50 states or different states much easier. So it's been very hard for people to move this last year and a half just because of the madness and uncertainty related to the pandemic and other things. So there's that. We talked about a couple others already. Renovation lending, new construction, obviously expect that to start to ramp up a little bit. Automation in general, I think that, like the borrower facing front end, all the point of sales and CRM type stuff that borrowers see. We've seen a lot of advancement in that space these last 3-4 years, but that back end automation, right? Things that can help automate the loan manufacturing process, which as human as ever. Now, a lot of it was volume related, but just the proliferation of different products as refi starts to go away, if it's non-QM or just construction or different niche type products, and being able to have them and be good at them. Things I've heard from our lender member leaders. I guess sift through that and give me any thoughts you have on those topics or others as we head into the year ahead.
Well, I'll tell you, you're going to see expanded product, or a focus on expanded product company by company, right? So, getting into non-QM, I think this could be the year where non-QM breaks out in a way that's really relevant. Early stages of pandemic, you saw that kind of pull back on the non-QM side. And my thought was, okay, it's going to be gone for good, kind of like subprime, and just kind of, again, just to restate, definitely not subprime lending, but, it felt like that pattern or something. But then it came back, rather quickly, which is good sign. And as we go into 2022, I think it could be the year for, the non-QM side, construction and renovation products, I think will be there. I think we'll see an expanded, really focus on, communities that have been, somewhat left out of home ownership. I think that is an element that we'll start to see in 2022. As it relates to technology, we've seen an acceleration, to find those efficiencies, over the last 2 years. You had to accelerate things that were on your to-do list from a tech perspective, really became top line items very quickly. And it was, from a necessity standpoint, all elements of your business needed to adopt new tech, which is a good thing. We'll be able to put that on display in 2022. And I think that continues to evolve in ways that maybe we didn't completely expect, where, it's not just about technology of not having interaction with, let's say, your client or partner. It's having technology that's efficient, that does not trap you in the wilderness, right? It feels more natural. It feels better. And you're using communication modes that, are more natural to the client now. That's shifting into the market we're in versus, think about even just 10 years ago, the thought of, originations online at the level that they are would have been, hey, that's a pie in the sky kind of, wishful thinking. We're there today, right? So, this next year, I think we could put a lot of that on display. It does help from an efficiency standpoint. But in a lot of ways, I think it's, to help engage the client, to educate more. I think those are where I see really huge advancements on the tech side, the ability to share information quickly, but not eliminate that human contact, right? To have human contact, maybe it starts out text messaging and then it evolves into a phone call, where, a few years ago, it was phone call pretty much all the time. So we're seeing that shift and the way that we communicate shift. Those are all good things in my mind, and really are positives for the industry overall.
Chad, greatly appreciate your insight on the industry. Really appreciate you taking half an hour out to share it with us. And all the best to you and yours
You
in the
too.
new year. And here's a
Absolutely.
great year for Go Mortgage in 2022.
Well, I appreciate that. Thanks for having me, Rich. Happy holidays to you and to everyone on the call. And good luck to you going into 2022. You know, I wish the best for everybody viewing.
And to all our viewers and listeners and podcast listeners, be back next Tuesday, 2022. We'll be back every Tuesday at 2 p.m. Eastern for the last week in Mortgage Today. We're working really hard to continue to make this 30 very relevant minutes of your time each week, and greatly appreciate your participation as well. So Happy New Year to everybody, and we'll see you next Tuesday on the other end of the calendar. So take care and have a happy new year all. Okay.
Thank you.